You know, folks, in the previous video on Ride the Next Market Wave Early, I talked about the art of spotting the beginning of a big move, that quiet moment before the crowd wakes up. But today, we're going to turn the telescope around. Because as every old trader learns, spotting the start of a trend is only half the battle. The real money, the kind that stays in your pocket, comes from knowing when that same trend is about to run out of steam. So let's talk about something most traders learn the hard way: the 3 signs that a trend is about to end. Now, I've said it before, and I'll say it again, markets are nothing more than human nature painted in price. They rise on hope and fall on fear. The same emotions that drive them up are the ones that pull them back down. So if you want to know when a trend is nearing its finish, don't look for magic indicators. Look for exhaustion in price, in volume, and in behavior. Watch the crowd, because the crowd will always tell you more than the chart itself. The first sign that a trend is about to end is climax, the last gasp of enthusiasm. You've seen it. The stock that's been creeping up day after day suddenly explodes higher. Volume surges. News anchors start talking about it. Everyone who had doubts before now wants a piece. That's not the start of strength, my friend, that's the end of it. The crowd always buys last. The professionals sell into that excitement while the public is rushing in. Ask yourself who's left to buy after everyone already has. I've seen this play out time and again. A market will run beautifully for weeks, then in 1 or 2 wild sessions, it shoots up like a rocket. Traders call it momentum. I call it the last hurrah. Because right after that parabolic sprint, prices tend to wobble, then stall, and before you know it, gravity takes over. You see, every trend feeds on fresh participation. When there's no one left to buy, the trend dies of starvation. That's how it always happens. Do you remember the last time you chased a move because it just couldn't stop? How did that end? Now the second sign, and this one's quieter, is the failure to make new ground. A strong trend always climbs a wall of doubt. Each pullback gets bought, and each high gets broken. But once the trend starts losing breath, it'll show you. The rallies get shorter, the pullbacks get deeper, and suddenly that support everyone talks about isn't holding anymore. That's the market whispering, "I'm tired." I used to watch this happen in the ticker room back in my day. A stock that once moved up 5 points in an afternoon suddenly struggled to move 2. The tape slowed, and the volume dried up. Traders would call it a consolidation, hoping for another breakout. But I'd seen enough to know that when a trend stops acting right, it's usually over. Remember, prices have habits. When those habits change, something under the surface has changed too. And if you're listening closely, the tape tells you before the headlines do. Ask yourself, how often do you ignore those subtle signs because you want the move to continue? That's the trader's curse, believing instead of observing. I've made that mistake myself. The market doesn't care about your belief. It only responds to behavior. The third sign, and maybe the most dangerous of all, is the change in tone, the shift from confidence to confusion. This one's psychological. When a trend has gone on long enough, people start thinking it can't end. They've made money. They feel smart. They stop managing risk because they think they've mastered it. But that's exactly when the market humbles them. You'll start hearing chatter, analysts revising targets upward, friends telling you it's different this time. When you hear that, my friend, it's time to check the exits. A great market tops the same way a great party ends. Everyone feels good right before the lights come on. The crowd is still laughing, still drinking, but the host knows the night's over. In trading, you must learn to be that host. Know when the music's fading. Don't wait for the cleanup crew to tell you it's time to go. And remember how in Ride the Next Market Wave Early, we talked about positioning yourself before the crowd even knows what's happening. The same principle applies in reverse. The best traders don't just know how to ride a wave, they know how to step off before it crashes on the shore. You protect your capital not by holding on to every trend, but by recognizing when it's showing signs of fatigue. Now let's slow down for a second. You might be wondering, Jesse, how can I tell the difference between a pullback and an actual end of trend? That's a fine question, and one I've asked myself plenty of times. The answer lies in confirmation. When price, volume, and sentiment all start contradicting the trend, that's your warning. A single pullback doesn't end a trend, but a pattern of lower highs and lower volume rallies, that's the market writing its obituary in slow motion. It's not about prediction, it's about observation. Every price movement leaves a footprint. Every change in rhythm is a clue. You don't need a fancy algorithm to tell you. When the music's changed, you just need to listen. Too many traders look for certainty in a business built on probabilities. The best you can do is read the odds correctly, and when the odds shift, have the courage to act. Do you know what separates the winners from the broken-hearted in this game? It's not intelligence. It's not luck. It's discipline, the discipline to sell when others are greedy and to wait when others are desperate. I've seen traders lose fortunes simply because they refused to believe a trend could end. They called it a dip. They called it a buying opportunity. But the market doesn't care what you call it. It only moves on when it's ready. A wise trader once told me you can't fight the tape. I learned that the hard way. Every time I tried to argue with the market, I paid tuition in dollars. And that tuition adds up fast. So when you see those three signs, the climax of volume and emotion, the failure to make new ground, and the change in tone, don't argue. Step aside. Let the market prove itself before you commit again. It's not fear that keeps you safe in the market, it's respect. Respect for the tape. Respect for the rhythm. Respect for the fact that no trend, no matter how strong, lasts forever. Because at the end of the day, trends don't die of old age, they die of exhaustion. And the smart trader doesn't get caught holding a tired market. He listens, he observes, and when the signs line up, he acts. Trend exhaustion often shows first through a volume and price climax. That's the first real sign the party's ending, even though it still feels like it's just getting good. Most traders mistake that burst of action for strength. They see price leaping higher, volume exploding, and they think, this thing's unstoppable. But the truth is that rush of energy is usually the last gasp before the move collapses under its own weight. I've seen it in stocks, commodities, currencies. It doesn't matter what the instrument is. Human nature doesn't change, and the tape records it all the same way every time. When a market's been trending for a while, the professionals who caught it early are sitting on profits. They've been patient, letting the crowd slowly discover what they already knew. The longer the trend lasts, the more confident that crowd becomes. At first, it's just a handful of bold traders stepping in. Then, as price continues to climb, the hesitant ones start following. By the time the newspapers and social media catch on, the professionals are already looking for the exit. And that's when the climax forms, when everyone who could buy has already bought, and all that's left is a final burst of enthusiasm before the air runs out. You can see it clear as day if you know what to look for. Volume spikes like never before. Price bars stretch longer. The chart looks like it's running away from you. But that's not strength, that's desperation. It's the crowd trying to squeeze through the same narrow doorway. And if you've ever tried to exit a crowded theater after the show, you know what happens when everyone moves at once. The rush is chaotic, unsustainable, and brief. Ask yourself, why do so many traders lose their gains right after a massive breakout? It's because they confuse climax with continuation. They think the surge means there's more to come, when in reality it means the tank's almost empty. A healthy trend doesn't explode, it breathes. It moves with rhythm, wave after wave, giving you time to position yourself. When that rhythm breaks and turns manic, you're no longer in a trend, you're in a frenzy. Volume is the market's pulse. When that pulse starts racing wildly, you should pay attention. It's not telling you to chase, it's warning you that something's about to change. I've always said, volume confirms price until it doesn't. When price is pushing higher but volume shoots to record levels, it means buyers are expending tremendous effort just to keep the move alive. That's not sustainable. Think of it like a runner sprinting the last stretch of a marathon. The burst looks impressive, but it can't last. You might remember from Ride the Next Market Wave early how we talked about getting in before the crowd, catching that quiet, steady accumulation when volume begins to grow but price hasn't yet taken off. The volume climax is the other side of that coin. It's the final stage when participation peaks and smart money quietly sells to eager newcomers. The same energy that once fueled the rise now signals its exhaustion. Let's picture it. Suppose a stock has been moving from 50 to 90 over several weeks. The chart looks beautiful, higher highs, higher lows, smooth pullbacks, rising volume. Then one day, it gaps up to 100 on enormous volume. Traders on the sidelines can't stand it anymore. They pile in. The next day it touches 105, but volume is even higher. By the third day, price starts to wobble. The candle has a long upper wick, and volume hits a record. That's your climax. It doesn't mean the trend reverses that instant, but it means the easy money's gone. From there, risk outweighs reward. And here's the trick: the climax doesn't just happen at the top. It happens at bottoms too. In downtrends, it's the panic phase when sellers throw everything out the window. Volume surges, price collapses, and the market looks doomed. But that's usually the point where professionals start buying quietly. The same psychological law applies in both directions. When emotion hits its peak, exhaustion follows. Have you ever noticed how quiet markets are before big moves, and how noisy they are before reversals? That's the pattern. Early in a trend, there's disbelief, silence, and slow accumulation. Near the end, there's shouting, excitement, and urgency. The crowd always joins late and exits late, and volume tells you exactly when that's happening. A trader who watches the tape carefully doesn't need fancy indicators to see this. You just look at how much effort the market is spending for every inch of progress. In a strong, healthy uptrend, each new high comes with moderate volume, a sign of steady buying. But when the same new highs demand explosive volume, it means buyers are running out of ammunition. The market's fighting harder for less reward. That's not strength, that's struggle. Think about it this way: if a man's climbing a hill and starts breathing harder, you know he's nearing the top. The market breathes the same way through volume. When it starts panting, you know it's losing altitude soon. The traders who understand that step aside before the stumble, the ones who don't get caught in the fall. There's something else about climaxes most traders don't realize: they're emotional turning points. When a market explodes with volume, that emotion doesn't vanish overnight. It has to cool off. That's why trends often flatten or reverse slowly after a climax. You can almost feel the exhaustion in the chart, the sideways drifting, the indecision, the fading conviction. It's like watching a runner who's given everything finally stopped to catch his breath. Do you remember a time you watched a chart and thought, it can't go any higher? And yet, it still did for one last wild push. That's the moment you should train yourself to recognize. It's seductive because it looks powerful. But behind that strength lies fragility. The professionals see it, the crowd doesn't. And if you listen closely to the tape during a climax, you'll notice something subtle: the tone changes. The buying feels frantic, the spreads widen, and the price action becomes erratic. That's not control, that's chaos. A seasoned trader feels that shift in rhythm and knows what it means. The smart ones quietly take profits while everyone else is shouting for more, because they know the tape always whispers before it screams. A failure to make new highs or lows is one of the market's most honest signals that a trend is running out of breath. It's quiet, it's subtle, and that's what makes it powerful. Most traders miss it because they're busy looking for excitement. They want fireworks, not whispers. But the market, like human nature, reveals its truth in silence long before it shouts it. When a trend stops making progress, that's your first clue that something underneath has changed. The buyers or sellers who once had control are no longer winning the fight as easily as before. In every strong uptrend, you'll notice a pattern. The price keeps making higher highs and higher lows. Each breakout brings in new buyers, and each dip gets quickly supported. That rhythm is the heartbeat of a healthy trend. But the moment that rhythm falters, when a rally fails to reach a new high, or when a pullback dips just a little too low, That's when you should start paying attention, because the trend is whispering I'm losing strength. You see, a market doesn't turn suddenly without warning. It builds a top or bottom like a craftsman builds a table, one leg at a time. A series of failures to make new ground is the market's way of constructing the turning point. It's subtle. The first time it happens, traders dismiss it as noise. The second time, they call it consolidation. The third time, they start to worry. But by then, the shift has already begun. Ask yourself, have you ever held a position, watched it rally, and noticed it couldn't quite break the previous high? What did you tell yourself then? Most traders say, it's just a pause before the next move. And sometimes it is. But the real pros don't assume they observe. They watch how the price behaves when it approaches those old highs. Is volume confirming? Are the candles showing conviction or hesitation? A weak breakout that quickly fades isn't strength, it's a warning. The market's job is to deceive the largest number of people for the longest time possible. When it stops making new highs in an uptrend, it's setting the trap. Everyone still feels bullish because the price hasn't fallen much. But underneath that calm surface, the buying pressure that drove the trend has started to dry up. The big operators, the professionals who built their positions early, are quietly unloading. They sell a little here, a little there, letting the public buy their shares at premium prices. Back in my days watching the ticker, I'd see it often. A stock would have a great run, strong volume, clean structure. Then one afternoon, it would rally up near the old high but stall. No follow-through. The tape would slow, and I could almost feel the hesitation in the room. The next day, it'd try again and fail. To the untrained eye, it looked like just another pullback. But to me, it was the sound of footsteps leaving the party. In a downtrend, it's the same story in reverse. You watch for a failure to make new lows. When a stock that's been dropping suddenly can't push any further down, that's not random. It's exhaustion. The sellers who are confident are now struggling to make progress. Price starts flattening out, the bounces grow stronger, and before long, the trend changes direction. The crowd doesn't see it because they're still reacting to what was happening, not what's happening now. Do you remember how in Ride the Next Market Wave early, we talked about recognizing accumulation before the move begins? The principle here is the mirror image. When a trend fails to make new ground, you're witnessing distribution, the quiet unwinding of positions. The smart money that bought early is now passing the baton to the crowd, just as the next wave begins to fade. A failure to make new highs or lows is like a poker tell. It's small, but once you learn to spot it, you can't unsee it. It's the market's body language. It tells you whether it still has energy or if it's pretending. And believe me, the market can pretend very well. It'll give you one more fake breakout, one more burst of hope, just to lure in latecomers. But if that breakout doesn't hold, if price slips back below the old level quickly, that's confirmation that the strength was false. You can't measure this kind of thing with indicators alone. You need to feel the rhythm of the chart. Watch how the candles behave near critical levels. In a strong uptrend, each dip is shallow and buyers step in fast. In a tired trend, dips linger longer. Price hesitates, it chops, it feels heavy. The moves become labored. That's how you know the character of the market is changing. Think of it like pushing a boulder uphill. At first, the slope is manageable, and you make steady progress. But as you near the top, every inch takes more effort. Your legs start to shake. You push, but the rock doesn't move as easily. That's the same energy dynamic happening in a failing trend. The market's effort, volume, and volatility increases, but the result, price movement, decreases. That imbalance is your signal. A lot of traders make the mistake of waiting for confirmation that's too late. They want to see the reversal before they believe it. But by the time the chart paints an obvious double top or bottom, the best entry or exit has already passed. The key is to notice the behavioral change early when the market first shows it can't make new ground. That's when you start adjusting your position, tightening stops, or taking profits. You don't have to predict the top, you just have to recognize when the trend stops behaving like one. Have you ever wondered why professional traders always seem to get out just before the drop? It's not luck, it's observation. They're watching for those small failures, the highs that come up short, the lows that don't extend. They trust what the tape is telling them, not what they want it to say. Every strong move in the market eventually faces resistance, not from technical levels, but from exhaustion. The crowd can only buy so much, the sellers can only push so far. When the price starts stalling and can't make new territory, that's the story being told. The market's saying, I've given all I can for now. And if you listen closely, you'll hear that message long before everyone else does. Support and resistance flipping roles confirms the trend's transition phase. That's one of those market truths that sounds simple, but it's loaded with meaning once you've lived through a few cycles. In every chart, there comes a moment when what once held price up now starts to hold it down, or what once capped a move suddenly becomes its foundation. That's the market changing its mind, and when the market changes its mind, a trader better be listening. Every trend, whether up or down, builds a structure as it moves. Prices respect certain levels again and again. Those are the battle lines between buyers and sellers. In an uptrend, the buyers defend their territory every time price dips to support. In a downtrend, the sellers attack every time price nears resistance. But when that pattern reverses, when buyers stop showing up at support or sellers can't push price lower at resistance, it means the power has shifted. That's not random noise. That's the birth of a new phase. I've always said the tape doesn't lie. When support breaks, and that same level later turns into resistance, the market is showing you that psychology has flipped. The people who bought there before are now trapped. They're anxious. So when price rallies back to that level, they're eager to get out even, turning old support into new selling pressure. The same goes for the opposite case when resistance breaks and becomes support. Those who missed the move earlier are waiting to buy on a pullback. What you're watching isn't just numbers, it's human behavior drawn out in price form. Ask yourself, have you ever seen a stock break down hard, then rally right back to where it fell from and stall again? You probably thought, it's trying to recover. But what's really happening is a psychological handoff. Buyers who once felt safe at that level now just want their money back. They're not thinking about making a profit anymore. They're thinking about escape. That's what turns support into resistance, regret. And in trading, regret leaves fingerprints all over the chart. The same thing happens in reverse when a downtrend finally gives way to strength. Price breaks through a ceiling that held it back for months. At first, traders doubt it. They call it a fake breakout. But then price comes back down to test that old level and holds steady. What was once resistance is now acting as support. That's the market's quiet way of saying, something's changed. When you see that kind of retest hold firm, that's not coincidence, it's confirmation. You'll notice that real professionals wait for that kind of flip before they commit heavily. They don't chase the breakout itself, they wait for the retest that proves the crowd psychology has shifted. Because anyone can push the price through a level for a moment, it's staying there that tells the truth. The market's like a man, it can make promises in excitement, but only consistency proves what it really means. Support and resistance flips also tie back to the emotional rhythm of a trend. When a market's rising, confidence builds in steps. Traders see that support keeps holding, so they add on dips. It becomes a habit. Then, suddenly, one of those dips doesn't bounce. Price slices through like it's not even there. That's when the smart trader knows something has changed, the rhythm's broken. What was supposed to hold didn't. That's not a reason to panic, but it is a reason to pay attention. The next time price approaches that old support from below, it's a test of whether the market still believes in the old story. And if you remember from Ride the Next Market Wave early, we talked about how trends start with quiet accumulation before the crowd catches on. Well, when support and resistance start flipping, that's the other side of that wave. It's the transition point, the moment where the crowd is still living in the old trend, while the professionals are already trading the new one. They see the flips early because they're not emotionally tied to the move. They read what the market's doing, not what they hope it'll do. Think about a strong uptrend that's been running for months. Price keeps bouncing off support zones and making higher highs. Then one day, a sell-off slices through a support level that's held 3 times before. Traders tell themselves it's temporary, but when price rallies back and fails to reclaim that same level, you've got a problem. That level's now acting as a ceiling. The market's telling you, the buyers who once controlled this space are gone. That's how a top forms, not in a single crash, but in that quiet moment when strength turns into weakness. It's the same story at bottoms. In a strong downtrend, every rally stalls at resistance. Sellers dominate and buyers keep getting pushed back. Then one day, a rally breaks through resistance cleanly. At first, traders don't trust it. They wait for the next pullback. When price dips back to test that old resistance and it holds, that's the transition. What used to repel buyers now attracts them. It's a sign of new demand, fresh energy. That's where the next big move is born, not in the breakout itself, but in the validation afterward. Have you noticed how these flips are more reliable than any technical indicator? It's because they're rooted in human reaction. Every time price revisits a familiar level, the traders who were hurt there before respond emotionally. They remember the pain or the missed opportunity. That memory creates predictable behavior. When enough traders feel the same thing at the same price, that level becomes powerful. And when that collective emotion reverses direction, the level's purpose reverses with it. In the ticker rooms, I used to watch traders get fooled by false hope. They'd see a stock bounce off a level, call it support, and load up. Then, when the floor gave way, they'd freeze. When the price later came back to that level, they'd sell out in relief right before the next leg down. The market doesn't care about your feelings, but it always reacts to the crowd psychology. Support turning into resistance is just that psychology crystallized. There's a rhythm to how these flips unfold. First, the break, that's the shock. Then the retest, that's the test of conviction. Finally, the follow-through, that's the confirmation that sentiment has changed. If you train your eyes to see that sequence, you'll start recognizing transitions earlier than most. Because every big reversal in market history, no matter how dramatic it looked in hindsight, started with that simple change: what once supported now resists, or what once resisted now supports. The most reliable traders observe, not predict, and act when the tape changes character. That idea sounds simple, but it separates the professionals from the hopeful gamblers. Most people come to the market trying to predict what will happen next. They want to call the top, pick the bottom, or forecast the next big rally. But the truth is, prediction is the ego's game. Observation is the trader's craft. The market doesn't reward fortune tellers, it rewards those who can see clearly and act without emotion when the evidence shifts. I learned this the hard way. Early in my trading years, I wanted to be right more than I wanted to make money. I'd stare at charts and convince myself I knew where the price was headed. Sometimes I got lucky, and those moments fooled me into believing I'd figured it out. But luck has a cruel way of pretending to be skill. Eventually, the market showed me the difference. Every time I held a position because I thought I knew better, I paid for it. And every time I simply followed what the tape was saying, I survived. Observation keeps you alive. Prediction feeds your pride. When you observe, you accept that the market is bigger than your opinion. You stop arguing with price. You stop trying to impose your will. You listen. The tape speaks through price, volume, and behavior. It doesn't whisper in words, it moves in patterns, reactions, and rhythm. An observant trader watches how the market behaves after key events. He notices whether it confirms strength or fades on weakness. When the character of the move changes, when reactions slow, when volume dries up, when volatility spikes out of nowhere, he knows something's different. Ask yourself, how often have you ignored the signs because you were too attached to being right? You saw the price turning against you, but you called it noise. You watched volume shift, but you told yourself it was temporary. That's prediction at work. Observation would have told you to step aside and reassess. The market gives hints long before it gives answers. Most traders are too busy arguing with it to notice. Observation requires humility. It means admitting you don't control the outcome. You're just interpreting what's happening and aligning yourself with it. The moment you think you can predict the future, you stop listening. And the moment you stop listening, the market will remind you who's in charge. It does that without mercy. I've seen traders wipe out months of profit because they refused to acknowledge that the tape had changed. They clung to the past when the present was already different. When the tape changes character, it's like a person changing tone mid-conversation. You can feel it. A stock that once moved smoothly starts jerking around. The dips get deeper, the rallies get shorter. Maybe the news is still good, maybe the analysts are still bullish, but the price doesn't respond the same way anymore. That's not coincidence, that's transformation. An observer sees it as soon as it happens. A predictor argues that it shouldn't be happening. Guess which one keeps their money? When a trader sits down in front of the tape, the temptation is always the same. He wants to outsmart the market. He wants to find a clever trick, a secret indicator, something nobody else has seen. But I tell you plain, the market doesn't pay you for cleverness. It pays you for patience, discipline, and simplicity. Now, you might think that sounds dull. After all, isn't trading about excitement? Isn't it about finding the hidden move before anyone else? No, it isn't. Trading is about surviving first, and then prospering second. And survival comes from following the trend, not from complicating it with fancy notions. You remember the previous video on how to catch big trends, and today this thought goes one step further, because once you spot that trend, the real money comes not from analysis, but from sticking with it. A man could sit there with 20 oscillators, colored lines all over his chart, arrows pointing every which way. Does it help him? Does it make him a better trader? No, it makes him a confused trader. The market doesn't care about your chart decorations. The market cares about supply and demand. Price is the final judge, and trend is its verdict. Do you know why most men lose? They don't like simple answers. They want a magic formula, something that makes them feel smarter than the crowd. But the crowd is already showing its hand on the tape. Why not read it instead of trying to reinvent it? When I was a boy, running errands and watching the ticker in the bucket shops, I learned early the tape doesn't lie. Every rise, every decline, it was right there in black and white. I didn't need to clutter it up with theories. I just needed to read it and act when it spoke. Do you do that yourself? Or do you wait until your neighbor agrees, or your broker nods his head, or your gut feels right? That hesitation is what keeps most men broke. They want confirmation on top of confirmation. By the time they get it, the move has already gone. You see, trend following is the only thing that makes sense in speculation. The market can move sideways, sure, but when it chooses direction, that's where the real opportunity is. And if you try to fight it, if you decide that you know better than the broad sweep of money flowing in and out, you'll learn the hard way. I've seen men bet against a bull market simply because they thought stocks were too high. And I've seen others short a bear market because they thought prices had already fallen too far. What happened to them? The trend broke them. They complicated what was simple. Are you making the same mistake? It's like this: if you need reasons to explain why a stock is rising, you'll always be behind. If you simply see that it is rising, that buyers are in control, you're already in line with the facts. Why pile complication on top of facts? The hardest thing for a man to accept is that the simplest rule is often the best one. Buy when it's going up. Sell when it's going down. Sit still when the market is drifting. That's the whole story. But most traders won't take it. They think it can't be that easy. They think simplicity is for fools. And so they blind themselves with theories until the money has already passed them by. I'll tell you what complexity really is. It's fear in disguise. A trader who layers his screen with indicators is trying to protect himself from doubt. He thinks if he has 10 reasons to act, he won't be wrong. But what happens? He ends up with 10 conflicting signals, and he doesn't act at all. The market punishes hesitation. Have you ever frozen while the price moved without you? That's what too much thinking does. The man who studies too long misses the train, and then he calls it gambling when he should have called it discipline. Now, simplicity doesn't mean carelessness. Don't mistake one for the other. Simple rules must be applied with strictness. The simplest rule of all is cut your losses. But how many traders follow it? Most hold on, hoping the market will turn back their way. They complicate a simple exit with 1,000 excuses. And what's the result? Small mistakes become big disasters. I made my fortune not by avoiding losses, but by cutting them fast and letting the winners ride. That's simplicity in practice. Are you able to do it? Or do you talk yourself out of it every time? There's a reason I say the big money is not in the buying or the selling, but in the waiting. The waiting requires the same simplicity. When you've entered with the trend, your only job is to sit still. Most men can't do it. They want to tinker, to take profits too early, to second-guess themselves. They complicate what should be easy, hold as long as the trend is alive. Every premature exit costs them more than their losing trades. They don't see it, but it's true. Can you hold through the noise? Can you trust the trend more than your nerves? I've always said that markets are never wrong, opinions often are. And the more complex your opinions, the more chances you give yourself to be wrong. Simplicity narrows the path. One rule, one signal, one decision. Did the stock break out and hold? Buy it. Did the stock break down and keep falling? Sell it. Did nothing happen? Do nothing. There's no shame in standing aside. Most fortunes were built by waiting for the right moment, not by trading every tick. But ask yourself, are you strong enough to do nothing? That is the simplest and the hardest rule at once. When I think back to the days when I lost, it was always because I strayed from the simple path. I listened to tips, I overtraded, I tried to predict instead of follow. The losses were the tuition I paid to learn that simplicity isn't childish, it's wisdom. Do you find yourself chasing news, searching for explanations, wondering why the market moved today? Stop it. The why doesn't matter. The what is all that counts, and the what is written plainly on the tape. A man who can't read the what will never profit from the why. And let's not forget the money side of it, the part beyond the charts. Wealth is built not by the number of trades you make, but by the size of the moves you capture. One big trend, ridden properly, pays more than 100 little scalps. That's why you need to keep your capital intact for the right opportunity. Complexity makes you burn through commissions, spreads, and your own nerves. Simplicity saves your stake until the true move arrives. Isn't that what you want? To grow your account steadily instead of chopping it up for scraps. Here's the truth. The market rewards the man who does less, not the man who does more. But doing less doesn't mean being lazy. It means being selective. It means you wait for a clear trend, you act decisively, and then you leave it alone. If you think that's too easy, try it for a year. You'll see how hard it is to keep your hands off when the market tempts you with little swings. But every time you avoid taking the bait, you save yourself from unnecessary risk. That's how accounts survive to catch the real trend. Remember how in the last video I showed you ways to spot the big trends? Well, this is where the principle ties together. Spotting is one part, staying with them is the other. Without simplicity, you'll never hold long enough to profit. Think of the men who went broke in every great bull and bear cycle. They weren't wiped out because they couldn't read a chart. They were wiped out because they couldn't keep it simple. They thought they had found a way to improve on the market's message, and the market punished their pride. You can't improve on the trend. You can only follow it. The more quickly you accept that, the sooner you start keeping what you make. Do you want to be the man who makes money and gives it back, or the man who compounds steadily over years? Now, understand me, I don't mean you should be blind. Simplicity is not stupidity. A trader must study the general conditions, the overall tide of the market. You can't buy stocks in a weak market and expect them to resist forever. The broad trend pulls them all. But once you've identified the tide, your task is simple: swim with it. Don't argue, don't invent exceptions, Don't fight for the sake of pride. The tide is stronger than you. You'll drown if you fight. Will you accept that truth, or will you insist on learning the hard way? When I made my largest profits, it wasn't because I had a dozen reasons to buy. It was because I had one simple conviction. The market was trending, and I must be on its side. That was enough. All the rest was noise. The longer I traded, the more I learned to throw away. Every layer of complexity removed. Every useless tool discarded sharpened my judgment. A cluttered mind cannot see clearly. A simple mind can act decisively. Isn't that what you want in the heat of trading, to act without hesitation? The fact is, markets haven't changed. Men still get greedy, fearful, hopeful, stubborn. The same emotions drive the same cycles. If you complicate your rules, you give those emotions more places to sneak in. Simplicity blocks them out. One look at the chart, one decision. No room for argument. That's how you keep yourself safe from yourself. Ask yourself honestly, do you want to be right, or do you want to be rich? Because complexity is for the man who wants to prove he's right. Simplicity is for the man who wants to keep his profits. So when you sit down tomorrow and look at your charts, ask yourself, am I making this too complicated? Am I decorating the screen to feel smart, or am I reading the bare message of price? If the market is rising, it tells you buyers are stronger. If the market is falling, sellers are stronger. That's all you need to know. Trade with that, and you'll last. Trade against it, and you'll perish. It doesn't matter what you, or I think it matters only what the trend does. Will you accept that simplicity? Or will you keep searching for the secret that doesn't exist? Because let me tell you, there is no secret. The men who prosper are the men who accept the truth. They keep it simple, they keep it disciplined, and they stay with the trend until it bends. Then they step aside, wait again, and repeat. That's all there is to speculation. Anything else is vanity, and vanity is the most expensive habit a trader can have. Price action is the only true signal. A trader who forgets the truth is bound to get lost in the noise. What is price action? It is nothing more than the raw movement of the market itself. Every tick on the tape, every candle on the chart, every swing from high to low, that is price action. It tells you where money is flowing, which side is pressing harder, who is winning the struggle at that moment. Everything else, indicators, theories, opinions, is a translation of that simple language. But the problem is, when you start trusting the translations more than the original, you introduce distortion, and distortion is costly in this business. The market doesn't care about your favorite oscillator, your carefully drawn Fibonacci retracements, or the special formula you bought from some trading guru. All of those tools are built from the same raw ingredient, price. If you strip them down, they are nothing but delayed reflections of what has already happened on the tape. So why look at a shadow when you can look directly at the object casting it? That's the logic behind focusing on price action. It's like listening to a messenger instead of the man who sent him. Would you rather hear the words first then, or through a chain of whispers? I remember in my early days, when I sat in the bucket shops staring at the ticker, I didn't have the luxury of charts filled with lines and signals. I had the tape. Numbers rolling fast, showing me which stocks were moving, how fast they were moving, how the volume backed up the motion. It was pure price action. I learned to sense strength and weakness directly from those prints. If a stock kept pushing higher, no matter how many times it pulled back, I knew the buyers had the upper hand. If it kept sinking despite rallies, I knew the sellers had control. It was simple. Do you see how clear it becomes when you strip away the clutter? Most traders confuse themselves by demanding reasons for every move. They want to know why a stock is rising, why it is falling. They look for news headlines, analyst opinions, economic forecasts. But here's the truth, the why is almost always revealed after the move is already underway. By the time the explanation arrives, the price has already traveled miles. A trader who waits for the why is chasing shadows. The only thing that matters in the moment is the price itself. Is it climbing? Is it dropping? Is it stalling? That's what you trade. Everything else is gossip. Think of it this way: when you see a man running out of a burning building, Do you need to read the fire report before you step aside? No, you trust what your eyes tell you. Price action is that man running. It's the raw evidence. Ignore it, and you'll get burned. Too many traders learn this lesson late, after they've placed trades based on logic or opinion and watched the market do the exact opposite. Price doesn't care about logic. It doesn't bend to your reasoning. It follows its own course, and your only job is to recognize it and follow along. Now, when I say price action is the only true signal, I don't mean it makes trading easy. The difficulty lies in trusting it without second guessing. A stock may rise for 3 days straight, then pause. Many traders jump in too late or jump out too early, depending on their nerves. The challenge is to read the continuation or the reversal without adding your imagination on top. That takes practice, observation, and discipline. Are you willing to spend the hours watching the tape, studying how trends unfold, how consolidations resolve? Or do you prefer shortcuts, tools that promise to predict what comes next? Because I'll tell you, there are no shortcuts that work consistently. Only price action tells the truth, and even then, it requires you to respect it with patience. A lot of traders treat price action like it's too simple to be trusted. They want sophistication, complexity, the feeling of being in control through formulas. But what happens when their formulas fail? They blame the tool, they search for a new one, and they never build confidence in their own reading of the market. Price action forces you to develop your judgment. It strips away excuses. If you bought in an uptrend and the trend reversed, you can't argue with the chart. It tells you plainly that your position is wrong. You must cut it. That's why so many resist price action. They don't want the brutal honesty of it. But brutal honesty is the only thing that keeps you solvent. Another point is that price action reflects psychology better than anything else. Every tick is the result of human decisions: buyers eager, sellers fearful, short sellers pressing, longs panicking. You can almost feel the crowd's emotion in the way a stock trades. Sharp rallies reveal urgency, grinding climbs reveal persistence, sudden collapses reveal panic. Isn't that more useful than any lagging indicator? If you can read the psychology in the chart, you can position yourself on the side of the stronger emotion, and the stronger emotion usually dictates the trend until exhaustion sets in. Do you train yourself to see these patterns, or do you hide behind borrowed signals? You may ask then, what does it mean in practice to trade only on price action? It means you base your decisions on clear structures, higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend, breakouts from consolidations, reversals from climactic moves. These are the footprints of money flowing in or out. They are visible without embellishment. If you stay true to these footprints, you'll align with the dominant force in the market. If you start second guessing because some indicator says overbought or oversold, you'll miss the fact that overbought can stay overbought for months while price keeps climbing. How many traders have been ruined by selling a strong trend too early because their indicator told them it was stretched? That's the danger of ignoring raw price. I have seen this mistake countless times in my life. Traders think a stock has risen too far, too fast. They short it, expecting a pullback. The stock shrugs and climbs higher. Their loss grows, they add to the short, and eventually the trend buries them. The only thing they had to do was look at the action itself: steady demand, relentless buying, volume confirming strength. The tape was shouting at them, but they refused to listen. Why? Because they thought they were smarter than the market. They thought complexity could outwit simplicity. That's always the road to ruin. Another example: traders often hesitate to buy a breakout because they think it looks too obvious. They want to wait for a pullback, for confirmation, for some clever entry. Meanwhile, the stock marches higher, never looking back. Price action told the truth that the breakout buyers were overwhelming sellers. The balance had shifted decisively. But the trader ignored it in search of complexity. He missed the move, then tried to chase later, usually at the worst spot. Haven't you done that yourself at some point? I know I have, back in my learning years. That sting taught me to trust the obvious when it comes from price. Now let's talk about discipline. If price action is the only true signal, then you must build your entire discipline around it. That means respecting stop levels when price invalidates your setup. It means riding winners as long as the action supports them. It means staying out when price is indecisive. The hardest trades are often the ones where you must do nothing, where the tape shows no clear buyers. That's when traders invent complexity to justify action. They get restless, they want to be in the game. But the price is telling them plainly no edge here. Wait. If you don't listen, you pay. How many times have you forced trades in dull markets and regretted it later? That's the penalty for ignoring the only signal that matters. You might wonder if price action alone can really guide long-term wealth building. The answer is yes, because wealth is compounded not from constant tinkering, but from capturing major trends. And the only way to stay in major trends is by trusting price action over opinions. If you waited for a complex indicator to tell you that a bull market was underway, you would always be late. Price action, however, shows you the tide as it turns higher highs, breakouts, volume flowing. That's when you align, and then you sit still. All the growth in accounts I've seen, whether mine or others, came from respecting those signals. Complexity only sliced the profits thinner, and this is the truth that many don't want to face. Simplicity demands courage. When you strip away the crutches of indicators, you're left alone with price. You can't blame the tool if you're wrong. You must own your judgment. That responsibility frightens many traders. They'd rather rely on a complex system so they can say, "The system failed, not me." But in the end, it's always you against the market, and the market speaks only through price. Are you brave enough to listen directly? Or do you prefer to hide behind filters that dull the message? Price action is not glamorous. It doesn't make you feel like a genius. It makes you feel like a student, always watching, always learning. But that humility is what keeps you alive. The man who thinks he has found something better than price action usually learns that his method is just another way of dressing up the same thing, and usually later, when his losses have grown too large to ignore. The man who sticks to price action, though, builds a foundation that never goes out of date. Markets evolve, tools change, but price action is eternal. It is the heartbeat of speculation. Ignore it, and you trade blind. So when you hear me say that price action is the only true signal, don't mistake it for a slogan. It is the backbone of every profitable career in trading. Strip down the greatest speculators' methods, and you'll find they were always following price in one way or another. They may have had different styles, different time frames, but the essence was the same. They let the market show its hand, and they acted on it. You can either do the same, or you can spend years chasing complexity, only to circle back to the same truth. Which road will you take? Complexity creates hesitation, simplicity creates clarity. That is the rule, as plain as it gets. A trader who fills his screen with 10 different signals is really filling his mind with 10 different excuses to doubt himself. And in the market, doubt is expensive. When you hesitate, the market moves without you, and when you chase after it, you pay too much. I have seen it happen in every cycle, and I have felt it in my own account in my early years. The moments I cluttered my trading with complexity were the moments my decisions slowed, and the tape punished me for waiting too long. Think about what happens when you walk into a room filled with noise. You hear voices, music, clatter so much that you can't focus on one sound. You miss the message entirely. That's what a chart looks like when you load it with indicators, theories, and conflicting opinions. It's noise. The true signal, which is price, gets buried under layers of distraction. You keep asking yourself which voice to believe, and by the time you choose, the market has already delivered its verdict. Haven't you noticed how the simplest trades often look the clearest in hindsight? That clarity was always there, you just let complexity hide it. A man who studies too long ends up studying himself into paralysis. He wants everything to align perfectly before he acts. One signal tells him to buy, another says to wait, a third flashes a warning. What does he do? He does nothing, or he enters late, unsure, and then cuts his trade the moment the market wobbles. Complexity turns him into a hesitant creature, and the market does not reward hesitation, it punishes it. The men who win are the men who act with clarity, without dithering. And clarity comes from simplicity. Do you want to be decisive in trading? Then strip away what causes you to doubt. When I traded in the bucket shops, I didn't have time to hesitate. The tape moved quickly, and if you wanted to profit, you had to read the direction and act. There was no room for checking 10 studies or waiting for a committee of signals. If the stock was climbing steadily, you bought. If it was sliding persistently, you sold. Simple. That simplicity gave me clarity, and clarity gave me speed. The hesitation came later in my career, when I allowed outside opinions and complicated strategies to creep into my thinking. And every time I hesitated, the market made me pay. You may have felt the same sting hesitating to buy a breakout, only to watch it soar without you, or hesitating to cut a loss, only to watch it double against you. That hesitation was born of complexity. It's natural to think that adding more information should make us better traders. After all, doesn't more data mean more certainty? In trading, it does the opposite. More data brings more conflict. One indicator says the market is strong, another says it is weak. One analyst says buy, another says sell. You start weighing each argument, wasting precious minutes while price keeps marching. By the time you resolve the conflict, you're left with scraps. Simplicity cuts through this mess. It leaves you with one clear rule to follow, one direct signal to obey. And when your rule is clear, your action is immediate. That immediacy is what keeps you aligned with the market's moves. Have you ever noticed that the biggest mistakes often happen when you hesitate? A breakout forms, you see it, but you question it because your indicator doesn't confirm. You wait. The price takes off, and you chase it late. Or you're in a losing position, you know the price is against you, but you hesitate to cut it because you hope for a bounce. That moment of hesitation doubles your loss. Complexity created that pause, that small crack where doubt entered. If your rules had been simple, there would be no pause. Buy the breakout, cut the loss, hold the winner. Immediate, decisive, clear. Clarity is not just a comfort, it's a weapon. When you act with clarity, you remove the inner debate. You don't waste time arguing with yourself, and the market rewards speed. Trends don't wait for you to resolve your confusion. They move with or without you. That's why the men who keep things simple often look lucky to others. They aren't lucky, they are clear. They act when the signal appears, and they ride the move while the hesitant traders are still deciding. Do you want to be one of the hesitant, always a step behind, or one of the decisive, always aligned with the tide? There's another danger to complexity. It gives you false confidence. A trader loads his chart with studies and believes that the combination will guarantee accuracy. He feels safe. But that safety is an illusion, because when the signals conflict, his confidence collapses. He realizes he has no clarity, only a pile of conflicting voices. His decisions become erratic, switching from one argument to another, and the market punishes his inconsistency. Simplicity, on the other hand, doesn't promise perfection. It accepts that losses happen, but because it is clear, it allows you to cut losses quickly and hold winners patiently. Which approach do you think keeps a trader solvent in the long run? Let me tell you, the market thrives on exploiting hesitation. Every false breakout, every shakeout, every sharp reversal is designed to test your clarity. If you are simple in your method, you know when to hold and when to fold. You don't fall for every feint. But if you are complex, every feint becomes an excuse to doubt yourself, to change your plan, to hesitate. And once you hesitate, the market takes your money. Traders don't lose because the market is too hard to read. They lose because they are too tangled in their own complexity to act on what is already obvious. Consider how wealth is really built in trading. Not by catching every small swing, but by holding through the major moves. And to hold through those moves, you need clarity. A complex system will tempt you to exit early, to doubt the trend, to second guess. A simple system will keep you aligned with the price as long as it continues in your favor. Clarity helps you sit still when you must, which is often harder than pulling the trigger. Most men cut their winners short because they lack clarity. They let a dozen reasons convince them to take small profits, and then they let their losers grow because they hesitate to admit they're wrong. Complexity cuts them down from both sides. Simplicity builds them up. Clarity also saves energy. Trading is exhausting when your mind is cluttered with conflicting signals. Every decision feels heavy. Every move requires debate. You burn mental capital, and eventually you make careless errors. Simplicity lightens the load. When your rule is clear, you don't waste time on arguments. You conserve energy for discipline, for patience, for observation. And in trading, conserving energy is as important as conserving money. Have you ever felt drained after a day of overthinking trades? That's the toll of complexity. Simplicity keeps you sharp. Many traders resist this idea because simplicity feels too exposed. They think, if my rule is too simple, I'll be wrong too often. But being wrong is part of trading. The danger is not being wrong, it's being hesitant. A simple rule lets you act and accept a small loss quickly. A complex rule makes you hesitate, and that hesitation turns a small mistake into a big one. It's not about being right all the time. It's about being clear enough to cut wrong trades and ride right ones. That is the true edge. Think about your own trading for a moment. How many times have you stared at the screen, frozen between conflicting signals? How many times did you hesitate, only to regret it later? And how often did you find that the cleanest moves were also the simplest to read, if only you had trusted them? That is the lesson. Complexity is hesitation, simplicity is clarity, and clarity is the difference between acting in step with the market and being left behind. The simplest rule of all is to cut your losses, yet it is also the rule most often broken. A trader will preach it, write it down, even tell others to follow it, but when his own money is on the line, he hesitates. He makes excuses. He convinces himself that the market will turn. He lets hope creep in. That hope is the most expensive thing in speculation. It turns a small loss that could have been brushed aside into a large wound that cripples your account. Why do so many ignore this simplest of rules? Because the market does not punish them immediately. It teases them with moments of recovery. It whispers that they might be right after all. And so they wait, and while they wait, their capital slips away. Cutting losses quickly is not about being perfect. It is about being alive long enough to catch the moves that matter.